Well, this is test understanding number 5 from the revision kit. This question gives you statements of parent and subsidiary company as at of 30th June 2008, right? But the two new things which we'll be discussing in this question is, let's say if a parent company gives a loan to a subsidiary company, so how will that affect the consolidated statement of financial position? And if there's any balance, a receivable and a payable to and from the parent and subsidiary within themselves, then how we are supposed to treat that. Okay. So now if you look up at this question, we'll start the workings. As you know that the first working would be to prepare the group structure. Okay. So here it says that the P has acquired 75% of subsidiary company on 1st of July 2005. So basically P is the parent company. Okay, that's the name. And the subsidiary company is S. The percentage of ownership is basically 75. So that gives you an NCI of 25%. Okay. And lastly, we also have the date of acquisition. So the date of acquisition is 1st of July 2005, and you are preparing at 30th June 2008. So that's like 3 years before the reporting date. Okay. So date of acquisition is 1st of July 2005. I'll write down over here 3 years before the reporting date. Okay. Now, once when you have done with the group structure, the second thing what you have to do is that you have to find out the net assets of the S company, I mean your subsidiary, at 1st of July 2005. And we will also do it for the reporting date, which is at 30th June 28. Okay. So that's what we need to do. And for this, we have to come up and look at the balance sheet of the subsidiary, because the reporting date, you can just simply find it from here. It says ordinary share capital at 50 cents. So basically the nominal value of one share is 50 cents. So the total valuation over here is 1,000. So this means that the number of shares what the subsidiary company have a total, that's 1,000 divided by 0.5. So that will give you 2,000 number of shares basically. So it has 2,000 number of shares and the nominal value is 50 cents. So that makes it up to a total value of 1,000, right? So here you have your ordinary share capital, which is at a valuation of 1,000 at the acquisition date, and that will also remain at the reporting date. However, for the retained earnings, it's 3,150. Okay. So that's going to be at the reporting date straightforward. But for the acquisition date, we need to look the information in the question if they have given for sure. Here, when the balance on the S retained earning was 1,150. Okay. So 1,150 was the retained earnings at the date when the parent P company acquired the subsidiary company, which is the S company. So the total net asset at the date of acquisition will be 1,000 plus 1,150. So this will give me 2,150. And that's at the reporting date, it will be 1,000 plus 3,150. So that's going to be 4,150 so far. We also need to check if there are any fair value adjustments. Okay. So as far as the fair value adjustment is concerned, I can find it over here in the third point, that at the date of acquisition, it was determined that the subsidiary is land. Now, land doesn't get depreciated, so you don't have to worry about the excess depreciation what you will be considering. at a carried at a cost of 2,500 had a fair value of 3,750. So we have two fair value adjustments over here. The first one is land, which is at a price up above by 1,250, I believe. So this is going to be 3,750 minus 2,500, if I'm not wrong. Yes. So 2,500. So this will give you a fair value adjustment of 1,250, which will increase the value of the net assets of the subsidiary at the acquisition date. And likewise, it will also increase the value of the net asset at the reporting date. But then you also have S plant was determined to have a fair value of 500 in excess of its carrying amount and had a remaining I'll show you this point, and had a remaining useful life of 5 years at this time. These values have not yet been recorded by S. Fine. So we need to make up an adjustment of 500 because they have already given you that that's the excess. So as far as the plant is concerned, you need to increase the net assets uh, at the acquisition date by 500 as well as at the reporting date by 500. Okay. So, but this plant, because you have increased the value of the asset, so it will account for an excess depreciation to be recorded, which in turn will be reducing the value of your net assets, right? So here, if you see this, it says that had a remaining life of 5 years at this time. Okay. So per year, there would be a depreciation of 500 divided by 5. But the fact is that the difference between the acquisition date and the reporting date is of 3 years, right? So if you have figured this thing out at the start of the question, things would be quite simpler for you. You need to multiply it by 3 because that's going to be the total depreciation that would have been charged in the 3 years from the acquisition to the reporting. So that gives me up to 300. Okay. So this will be considered to be as a reduction from the net asset, and that's why I'm writing it down in a subtract value. Right. So the one more thing what you are supposed to adjust over here is in case if there's any unrealized profit arising on the sale of goods from the subsidiary to the parent. But in this case, I don't find that we have anything like that in this question. So that's perfectly fine. Okay. That's perfectly fine, and that's it. So we can end up with this working by giving up a total, which is 2150 plus 1250, and then plus 500. Okay. So this gives me a total over here of 3900. This figure will be used to calculate your goodwill, and here it will be a total of 4150 plus 1250 for the fair value adjustment for the land and net 200 for the fair value adjustment for the plant. So this will give me a total of 5600, and that value I'm going to be using it for the calculation of my goodwill. The difference is basically 5600 minus 3900, and that I'm supposed to be using it for the value of my group retained earnings. Okay. So this is going to be working number 3. This is going to be working number 4. And then this will be working number 5. So we can highlight them. This one, and this one. Okay. 1 second here. It's a typing mistake. Okay. So now once you have done with the net assets, actually, you have to move towards the next value, which is basically your next working, which is your goodwill, right? So now we need to understand over here that P paid 3,500 for its investment in the share capital of S. Okay. So basically for the investment, 3,500 has been paid in terms of cash. So that's pretty much straightforward figure that for that 75% which we have acquired, the parent has acquired, they have paid like around 3,500. But you can see over here, it says that the P group uses a fair value method to value the NCI. For this purpose, the subsidiary share price at the date of acquisition should be used, which was I guess it's 2.2 per share at that date. Okay, so it's not 42.2. That 4 is by a typing error. It's actually $4. So 2.2 basically. Yeah. Right. So in this case, again, we have to calculate the goodwill based on the full value method. Okay. So if you are doing it on the full value method, then it means that you have to do the goodwill for the controlling interest as well as for the non-controlling interest. Okay. So, like, first we will have to find out the goodwill for 75%, right? And for that, we have to take the cost of investment, which is 3,500. Okay. Here, it was given to you in the question. And what has the parent acquired actually, like, uh, less share of parent in net assets of subsidiary. So this is like 3,900. From that 3,900, we have acquired 0.75. But the payment, what we are doing is 3,500. So we are paying them an extra. And that extra is basically considered to be as your goodwill. Okay. So the goodwill which belongs to the controlling part is 575. But then you can also find out the goodwill for the other 25 percentage. So for that, you have to take the fair value of the NCI at the reporting date, which they ask you to figure it out through the share price, which was 2.2 per share. Okay. So for this case, you already know that the total number of shares what the subsidiary company have is 2,000, and from there, we the NCI part is 25%. So that's like 500 number of shares, and the price per share is 2.2. So I'm going to multiply it by 2.2. Just adjust the formula. Yeah. So this gives me uh, a total valuation of 1,100 actually. Okay. So that's the fair value of NCI. Let's the NCI share in net assets, which is 25 percentage. So if from 3,900, if 75 percentage, which is 2,925 belongs to the controlling, the other 25 percentage, which is around 975 belongs to the NCI. So the market value of the NCI is higher by, I guess, 125. So that is considered to be as the goodwill, which is attributable to the NCI. So the total goodwill, what we have over here is 575 plus 125. So that's going to be 700. Okay. So that's the total goodwill arising at the date of acquisition. But then we do have impairments to date, which is like in the last 3 years, you have goodwill has been impaired by 100 actually. Okay. So if I record an impairment of 100, so the goodwill at the reporting date when I will be making up the balance sheet will be 600. Okay. So 700, then minus 100, you get 600. Okay. So once you have calculated the goodwill, it's better that you show it separately for the controlling interest and for the non-controlling interest. For the controlling interest, the goodwill was 575, but for the NCI, the goodwill is 125. There has been this is at the acquisition date, but then there has been an impairment of 100. So from that 100, 75 percentage belongs to the controlling part, which will be recorded in the group retained earnings, and the rest 25 will be a part of deduction in the NCI value. Okay. So that's 25. So that's 25 actually. Yeah. So the value which is for the controlling part is 500, and the one which is for the NCI, that's 100 only after the impairment, right? This 75 will be part of group retained earnings, and this 25 will be part of reduction in the NCI value. So once you have figured out your goodwill, now it's time to move to your NCI value. Okay. So for there, we have to take the net assets value, which is very simple. You just have to go to working number two back, which is 5,600, and then you have to multiply it by 25 percentage. So in that case, the value which is from the net asset is 1,400, but the goodwill you just calculated above right now after the impairment, which is 100. So the total value of NCI will be 1,500, 1,400 made up of net assets, and the other 100 made up of the goodwill. So that gives you 1,500 basically. Okay. The other way to calculate the NCI would be that you can take the fair value of the NCI at the date of acquisition, which you know that it's 1,100. And in that 1,100, you can add up the post-acquisition share of NCI in the increase in the net asset. So you can see the increase in the net asset has been 1,700, and the NCI share from there is basically 25 percentage, right? So that will give me a total of 1525. Okay. Uh, yes, 1525. And then you can subtract the impairment of the goodwill, which is 25. So you will get back again 1,500. Okay. So I'll just repeat for this one. You can start from the fair value of the NCI, right? And then you add up the NCI share in the increase in net assets from date of acquisition to date of reporting. And lastly, you can deduct the impairments. So you can see that this 1,500 which we calculated and this 1,500 which we calculated is exactly the same. So in section C, constructed response question, you are free to choose whichever method you want. But in case of the MCQ based question, it depends on how you can solve it based on the information given to you. Okay. So this impairment is also impairment, NCI share of impairment. Okay. So which is only 25. So that's way two to find out the NCI. This one, which I normally prefer, that's the way one. Okay. You need to know both the ways because the first one will be used for section C type of questions, but the second one can be used for MCQs type of questions. Then once you have find out the NCI value, now it's time to find out the group retained earnings. And for that, you have to take your parent retained earnings, which is a total of around 8,300, simple. But then you have to take the share, okay, the your share uh, in the increase in the net asset of the subsidiary company. So parents share in increase in net assets. So as we already figured out that that figure was 1,700, and from that 1,700, our share will be 75%, so 0.75. So it will become 1,275. So the total group retained earning will be this plus the subsidiary part, which is 9,575. However, you do have an impairment and your share was 75 over here. We don't have unwinding of discount. If we would have recorded it in the group retained earnings. We don't have any intra-group trading in which the parent is the seller, because if that would have been the case, you would have deducted the unrealized profit from the group retained earnings if the parent would have been the seller. But in this case, now you just have the impairment, which is your the parent's share, uh, goodwill impairment. Okay. Uh, Parents share, which is 75. So I'm going to write negative 75, and this will give me 9,575 and then minus 75. So we can get 9,500 as the final answer for the group retained earnings. Okay, so now as we have adjusted all these workings, now it's the time to make the consolidated balance sheet. Now, see, some points which are given to you in the exam question, the additional information, you have to figure it out while you are actually doing the workings. But then there are some adjustment which have nothing to do with the workings, but they will be considered while you are preparing the balance sheet, okay? The consolidated balance sheet. Now, for example, this point over here, which is second point over here, this point has nothing to do with the workings at the moment. This would be purely uh, related to when you're preparing the balance sheet, basically. Okay. And likewise, wait, so this one, no, this one, yeah. So this point has to be considered while you're preparing the balance sheet. And likewise over here also, not the whole point, but this point. At the same time, the parent invested in 60 percentage of S company's loan stock. So this point will also be considered while we are preparing the balance sheet. So with practice, you will actually understand that what points you have to consider while you're doing those top five workings, and then what values, what points you have to consider while you're making the balance sheet. So now it's time to make your balance sheet. Okay, so I just paste it over here. Yeah. Anyways, so here we have the total. We'll put the dollar sign over here. Right now, land. The first asset which we have is land. So I told you that you have to take for the parents' land and you have to take for the subsidiaries' land, and then you have to adjust for any fair value adjustment. And we did had a fair value adjustment of 1250 in the case of the subsidiaries adjustment. So yeah, that's it. So the total value for the land turns out to be 8250. Okay. Now see this for the plant and equipment. Okay. 2400 for the parent, 1750 for the subsidiary. But then we did had a fair value adjustment for the plant also, which was 500. And then there was a deduction of 300 for the excess depreciation. So 200 is basically what I have adjusted net in the value of the uh, plant and equipment as a fair value adjustment. Okay. So now moving further, we have an investment of 8,000. Okay, so now we need to understand that from that 8,000, obviously what you have done 3,500 is basically in the subsidiary. So here, if you see the question, how is it different that it's not written that what investments they have done? So it's a combined investments of 8,000. From there, 3,500 was obviously in the case of your the subsidiary, so this will be removed and it will be adjusted with the amount of goodwill which we have calculated. Okay. So the goodwill after the impairment, what we did was 600. So that 600 will be part over here. But then as you see that this point says that at the same time P invested in 60 percentage of S company's loan stock. Now here non-current liabilities, 8 percentage loan notes, the subsidiary have it at 500, and 60 percentage has been invested by the parent. So if the parent is giving subsidiary a loan or vice versa, on consolidation you have to remove those balances because it's all about the group. So unless they don't owe that amount to a third party, it will not be recorded in the consolidated balance sheet. Okay. So here we have to remove this. You see this from 4,500. We need to remove your 500 into 60% because that's a loan investment done by the parent company in the subsidiary company. So as an asset, I will also remove, and then later on in the liabilities, I'm also going to be removing that value. Okay, so this will become 500 into zero point 0.6, so 300. So this 4,200 is worth of other investments actually. Okay, so which are not to be deducted, right? Because the one which is in the subsidiaries are the one which will only be deducted, but the other investment will be shown in the consolidated statement of financial position because you're doing those investment outside the group. And then you have a goodwill over here of 600. Okay. So in this case, now the total non-current assets turns out to be 17.4, 17,400. Okay. Now, before I jump to the current asset, let me show you with this adjustment. At the reporting date, piece payable included an amount due to S of 400. Now, what this point means is that at the reporting date, the parent's payable included an amount due to subsidiary of 400. So it means that parent is saying that I have to pay $400 to the subsidiary company. But now try to understand this point. See, in cases when if this balance would have been agreed by the parent company and the subsidiary company, it's very simple. You just deduct 400 from the consolidated receivables and you also deduct 400 from the consolidated payables, right? If the amount is balanced and agreed by both the parent and the subsidiary. But normally what will happen is that in the exam question, these balances will not be tallied. A parent is saying that I have to pay 400 to the subsidiary, but let's say what does subsidiary has to say? This did not agree to the corresponding amount in S financial statement of 500. Subsidiary is saying that no, you don't have to pay me 400. I have to receive instead 500 from you. So from the subsidiary side, it's 500 receivable, but from the parent side, it's 400 payable. So what has caused the difference basically? Either it could be the inventory in transit or either it could be the cash in transit. Maybe the subsidiary has sold goods to the parent company which the parent company has not received, and that's why they have not increased their payables from 400 to 500. That's one reason, which we call it as inventory in transit. Second reason could be that the parent company have paid it to the subsidiary company. That's why they're saying that we now owe you 400 and not 500, but the cash is still in transit and it has not been received by the subsidiary company. So in that case, still the subsidiary receivables will be overstated. It will be at 500 because they still haven't received the money which the parent company is claiming that they have paid because it's still in the transit. The difference is due to cash in transit, and the question itself will tell you that what's the difference is all about. So that's because of the cash in transit. So I have nothing to worry about my inventories actually. So I can just simply consolidate them. It's 3,200 plus 900. Okay, so that's simple and straightforward. However, now you need to worry about the receivables and the payables and the bank, the cash. Okay, so for this, let me show you a working. I'll write it down. Parent says, uh, parent company says I have to pay subsidiary 400. Subsidiary company says I have to receive from parent 500. Okay. Now within the group, these balances actually don't make sense, right? So the entry would be that you're going to debit the payable, okay, because that payable is basically 400 over here because that's what the parent is saying, that I owe 400 to the subsidiary. So while you are consolidating, you don't have to show any payables and receivables within the group. So this debit payable of 400 will be on the debit side and the credit will be the receivables. Okay. So the receivables will go down by 500 because that's what the subsidiary is saying, that the parent owes me 500. So while you're consolidating, you actually don't have to record any receivable within the group or likewise any payable. So I'm removing those 400 and 500 respectively. Now you can see in this entry, you have a balance on the debit side, which is 100. And they have already told you in the exam that the reason for this, I mean, in the question, that the reason for this difference is basically the cash. So the cash, though the parent has recorded a cash payment like cash credit because they have made the payment to the subsidiary, but if you look from the group perspective, the cash has not left the group. So the parent credit of the bank has to be reversed. It will be debit. The cash has not gone out from the group. It's still there within the group actually. So I'm going to debit the cash by 100. Likewise, if the question would have said that the inventory was in transit, so likewise the inventory has also not went outside the group. So you have to increase your inventory again by 100. But in this case, as you know that the reason is cash, so the entry will remain till cash. The inventory I've just written in case if the question would have said that the inventory was in transit, but in this case it's not. Okay. Else it would have been I would have increased the value of my inventory by 100. So now you can see that your receivables have to be deducted by 500. So once you have consolidated them, okay, like this, 1400 plus 650, then you have to subtract the 500, which is the intra group basically. Okay, so that's gives you a net of 1550. As far as for the bank, you have to add 600 and then 150, and then you have to add up that 100 because that bank, that cash has not left outside the group, so that 100 will be increased in the value of your consolidated assets. So this gives me a total current assets of this plus this and plus 850 finally. So this gives me a 6500 balance, and my total assets will become this non-current assets total of 17.4 and then 6.5 for my current assets, and that will give me a total of 23,900 consolidated total assets actually. But then if you move up to the ordinary share capital, we just have to write down for the parent company. Group retained earnings, you just calculate it over here in working number 5. So just bring up that figure, uh, which is 9,500. You then have to record the part which you don't own, which is the NCI, and that is also being calculated in our working number 4, and that's going to be around 1500. So either you can take it through way 1 or you can take it through way 2. So that turns it up to 1500 over here. Total value of equity will be this plus this and plus this. Okay. Then you have your non-current liabilities. I told you that parent liabilities will be shown, but what is within the parent and subsidiary would be removed. So you have to, although you have to take 500, but then you have to subtract 500 into 60 percentage because that's just within the group we owe that amount. So we don't have to disclose it in the consolidated statement of financial position because those amounts are being owed within the group. So we need to remove that. So this gives me 4,200 over there. And for the current liabilities, you just have to add both of them. But yes, we do had a payable within the group that was 400, which the parent was believing that we owe it to the subsidiary company, so we need to remove that. And this will give you the total current liabilities at 3,700. So if I add them, it should be total to 23,900. So 16,000 is for my total equity after the NCI. The non-current liabilities are 4,200 and the current liabilities are 3,700. So this gives me an exact total of 23,900, and therefore my balance sheet is balanced entirely. Okay. So if you have any questions, please feel free to ask me. You can like, share, and subscribe. Thank you very much.